Can you indefinitely borrow against your own stock market account to never have to pay withdrawal taxes? Last year, a client asked me why his brother in law, who owns 3 rentals and a huge chunk of Apple from the early days, paid less in taxes than he did on a 92K a year salary. So it's a wildly different bill between the two. And the honest answer is his brother in law wasn't hiding anything. He was using a tax strategy that's fully legal, written into tax code, and used by every wealthy family in America. Most W-2 employees have just never heard of it. There's a number that should bother you. Right now, there's more than $20 trillion in unrealized gains sitting in American investment accounts, real estate, and business equity. None of it's taxed. Not a loophole someone stumbled upon, but Congress built this in on purpose. I do bookkeeping for a living. I look at balance sheets every day for landlords, business owners, people building real net worth instead of just collecting a paycheck. The gap between rich on paper and rich in the eyes of the IRS is enormous. It explains why some clients build wealth so much faster than others with similar incomes. The IRS does not tax you on wealth, it taxes you on transactions. If a stock you own doubles and you never sell it, that gain is just a number on a screen, not income until you trigger a taxable event. Think of it like an invitation. The IRS doesn't come knocking on your portfolio uninvited. You have to invite them in by selling or by taking a distribution. Every time you sell an appreciated asset, you're the one ringing the bell that says, come take your share. Plenty of people do it anyway because they assume it's the only way to actually use their money. That assumption is where most people lose ground they didn't have to lose. So if selling triggers the tax, how does anyone access the wealth without selling it? Well, the answer is borrowing. When you take out a loan, the cash you receive isn't taxable income. It never has been. A mortgage, a business line of credit, a margin loan against your brokerage account, none of it shows up as income because legally it isn't. It's debt and you owe it back. What most people never connect is that this applies to a stock portfolio just as easily as a house. If you own a few $100,000 in appreciated stock, most brokerages will let you borrow against it directly. No sale, no capital gains. Cash in your account within days. I've watched clients fund a renovation or a second property this way without selling shares and eating a tax bill on the gain. The stock keeps growing while they spend the borrowed cash, and the IRS has no claim on it. So a loan by itself isn't a strategy, right? It's a tool. The real strategy is what that tool does across 4 advantages, and the first is immediate. You access capital without paying tax on it. If you need cash for a down payment or a business expansion, the standard move is to sell stock or liquidate a part of a rental, and you trigger capital gain tax on the money you're not even keeping. You're just repositioning it. Borrowing skips that step. You get the cash, the assets keeps compounding untouched. I've had clients pull 6 figures out of a brokerage account this way, and their portfolio never noticed because the shares were never sold. But that's not even the best part. There's a fourth piece almost nobody hears about, and this is what makes the whole strategy click. It's called a step up in basis, possibly the single most powerful mechanic in the tax code. Say you bought a stock for $50,000, and by the time you pass away, it's worth $500,000. Sell it while alive, and you owe capital gain tax on that $450,000 gain. But hold it until death and pass it to your heirs, and the tax basis resets to current market value. That gain simply disappears for tax purposes. Not deferred, gone. Picture the full loop. You borrow against your assets while alive to fund your lifestyle, tax-free. The assets keep appreciating because you never sold them. When you pass away, decades of unrealized gains get wiped out through a step up in basis, and your heirs inherit at the new higher value with a clean slate. The loans get settled from the real estate, often by selling a portion of assets at that stepped up basis, meaning little to no tax owed there either. That's the full strategy people mean by borrow until you die. Not evasion, just legal rules used in the right order. Here's the piece outside this strategy that people always miss. None of this works if you're buying and selling constantly. The whole structure depends on holding assets long term, years or decades, without touching them. You have to be intentional from the start about what you buy. You're not picking up a stock to flip in 6 months. The moment you sell, you break the chain and trigger the exact tax event this approach exists to avoid. This is where people misapply it after watching a video like this. They hear borrow against your assets. They take out a loan against the stock they bought 8 months ago, planning to trade out soon anyway. That's not the strategy. That's stacking debt on a short-term position, and it usually ends badly. This only works when the asset was chosen to be held, not traded. So here's the decision this actually leaves you with. If you're holding real estate you plan to keep, stock you're not trying to time, a business you intend to grow rather than flip, understanding how to borrow against that equity instead of selling is worth real money over your lifetime. If your accounts are full of short-term trades, this isn't for you yet. There's no amount of borrowing fixes that. Match the tool to the asset, not the other way around. That's the mechanism. The way I explain it to clients who ask why people pay almost nothing on wealth, that keeps growing. 4 rules used in order. If this helped make sense of your own accounts, subscribe because I break down exactly this kind of stuff every week.